162.84. What happens when a supply chain bomb, a dovish shift, and a severe liquidity drought all collide on a single day? Hello everyone, welcome back to AI Market News. In today's explainer, we are navigating a highly complex and fast-moving situation. Based on available data, we are watching a perfect storm of converging market catalysts that could violently shift portfolios in the hours ahead. We have structural tech shifts meeting major central bank policy updates, all wrapped up in a dangerous liquidity vacuum. Here is our agenda for navigating this convergence. First, Apple's supply chain shock. Second, the Fed pivot and dollar weakness. Third, NFP and market liquidity. Fourth, two scenarios for USD/JPY. And finally, the economic calendar ahead. Let's dive right in. Section 1. Apple's supply chain shock. Overnight, a massive report hit the wires regarding a potential strategy shift from the world's largest consumer of advanced chips. As we can see in the chart, the NASDAQ and broader tech markets reacted sharply to news that Apple is exploring sourcing memory chips from two Chinese semiconductor companies. This move would potentially reduce their long-standing reliance on traditional heavyweights like SK Hynix and Kioxia. In fact, SK Hynix feels so sharply on this news that it helped push South Korea's Kospi below the 8,000 level for the first time in 3 weeks, and Kioxia followed suit in Tokyo. Now, what's really interesting here is the core concept behind this market reaction, which is the supply constraint thesis. Simply put, this is the expectation that a limited supply of advanced memory chips will continuously drive up prices, and by extension, stock valuations. So why does this matter to all of us? Well, if Apple finds new, cheaper sources in China, supply isn't actually constrained anymore. When supply opens up, pricing power falls. This underlying mechanism is exactly why AI memory stocks and the Nikkei reversed their earlier gains. It literally threatens the entire bull case for HBM and NAND stocks. Section 2. Fed pivot and dollar weakness. Moving to the broader macro landscape, we are seeing notable shifts in rhetoric from the U.S. Federal Reserve. Overnight, Fed Chair Warsh stated that inflation risks have, quote, receded. To understand the mechanics here, when a central bank acknowledges that inflation is cooling down, they are less likely to aggressively raise interest rates. Lower interest rates typically mean lower yields on government bonds, which generally weakens a country's currency because foreign capital seeks higher returns elsewhere. However, it's definitely worth noting that September rate hike odds remain fully priced in by the OIS market, meaning the broader market might be reading a bit too much into this single shift in tone. The graph shows exactly how this played out in real time. On the left, we observed the dollar index pulling back, and on the right, the sharp drop in USD/JPY. Chair Warsh's comments acted as the initial catalyst, but they were combined with weaker than expected economic data. Specifically, a miss in the ADP employment numbers at 98,000 and a miss in the ISM manufacturing index. This powerful combination of dovish Fed talk and soft economic data pulled USD/JPY down from its 39-year high of 162.84, bringing it all the way down to 162.30. Section 3. NFP and market liquidity. This is exactly where the structural text shifts and the Fed's dovish tone collide with an immediate trading danger. Tonight, all eyes are on the June non-farm payrolls, or NFP report, dropping at 8:30 a.m. Eastern Time, which corresponds to 9:30 p.m. JST. Look at the consensus estimates here. The market expects 113,000 jobs, a sharp drop from May's 172,000, with average hourly earnings ticking up 0.3% month over month. We need to remember exactly how high the stakes are right now. Just a month ago, May's massive upside beat triggered a 2.64% drop in the S&P 500 in a single day. The mechanism is quite straightforward. Strong jobs data means the Fed might keep rates higher for longer, which drives up yields and puts heavy pressure on stocks. But the jobs data is really only half the story. The absolute crucial point here is the intervention threat. Tomorrow is the U.S. Independence Day holiday, so markets are effectively closed. Because many global traders take the day off, today represents the last liquid session of the entire week. This creates a low-volume, extended weekend window. Historically, this exact type of illiquidity, combined with high USDJPY levels, is the prime strike zone used by the Japanese Ministry of Finance, or MOF, for currency intervention. We saw a very similar script play out in July 2024. When trading volume is this low, any intervention by the MOF has a heavily amplified, violent impact on the markets. Section 4. Two scenarios for USD/JPY.
Given this explosive setup, we need to focus on practical, actionable pathways heading into tonight. We have two distinct paths, and this brilliantly illustrates the risks all of us are facing. Under scenario A, we get a strong NFP print above 130,000. As discussed, strong jobs mean a resilient economy, so rate hike odds and yields spike. The dollar bounces, and USDJPY tests 163. This is the absolute danger zone for a sudden MOF intervention because of that holiday illiquidity. Conversely, under scenario B, we get a weak NFP below 90,000. Rate hike odds drop, aligning with the Fed's recent receding inflation comments. This forces an aggressive, panicked unwinding of crowded yen short positions, potentially causing a rapid 2 to 3 yen correction downward for USDJPY, giving equity markets a temporary reprieve.
Section 5. The economic calendar ahead. While tonight is the immediate hurdle, we definitely need to pivot to the broader horizon. According to current market information on the economic calendar, all of us need to keep a close eye on upcoming data. We must actively track three-star high volatility events, particularly central bank rate decisions. Looking ahead past tonight's NFP, future high-impact releases like the upcoming CPI and subsequent unemployment data will ultimately dictate the next major structural moves across the Forex, equity, and bond markets.
The base case is that we see some noise around the consensus today, and the market simply digests it without a major dislocation. But with the yen trading at these extreme levels, a still hawkish baseline from the Fed, and Japanese authorities on high alert, the risk of a violent move tonight is unusually high. Are we prepared for tonight's perfect storm? It is absolutely essential that all of us manage our size during this highly unusual risk environment. Keep both scenarios in mind. Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.